When I look at the open interest, to me it reflects the desperation that set in with the banks to try and control the price rise of gold. They'll have to just turn off the stock market to stop the selling. At some point, the plunge protection team is not going to be able to contain the selling that kicks in from the algos, the hedge fund algos, and so they're just going to pull the plug.
Ladies and gentlemen, welcome to the special interview. Today we have a returning guest to the show, Dave Kranzler of Investment Research Dynamics. Dave has the Short Sellers Journal and the Mining Stock Journal, and I got to tell you, not many people can pick apart an earnings report like Dave can, and that gives him an edge in these markets. And with the markets at all-time high, and with the miners about to go on a tear, people are going to need an edge. So I definitely recommend going over to Investment Research Dynamics and seeing what Dave has to offer. Dave, I'd like to welcome you again to Silver Doctors.
Thanks for having me back on, Paul. It's good to be here.
Now, Dave, let's go back to November 8th, November 9th, 2016. That was the largest trading volume day on the Comex, and that was the day that candidate Trump became President-elect Trump. Curiously, coming from this, we haven't had that kind of volume since then. Curiously, since June of this year, we've seen a lot of volume increases. In fact, I've counted 4 days where volume on the Comex has been over 600,000 contracts daily. Harvey Organ's also been top of this surging open interest on the Comex, where we've now breached 700,000 contracts of open interest. Could you explain what this explosion in trading volume means, what this surge in open interest means, and just what are you seeing when you're looking at the gold market right now, Dave?
What's going on the Comex is it just reflects what's going on in the overall financial system, and that is the paper assets, if you want to call them assets, the paper derivatives. I mean, even a stock is a derivative of an underlying business, and so anyway, it's just an explosion in the valuation of these paper assets that's being fueled by money printing, and the paper market is becoming increasingly disconnected from the underlying reality. Now, how that applies to the Comex? Well, we had that kind of sudden, unexpected, big run-up in the price of gold starting in, I think it really started kind of early May, mid-May, something like that, maybe the beginning of June. And I think that took a lot of people by surprise. I think it also took the banks that run massive short positions on the Comex by surprise. And quite frankly, regardless of what you read in the media, I mean, whatever you read from the World Gold Council or Bloomberg or about gold, just throw it out the window because it's propaganda. Reuters does okay reporting on it, but I do think that I think that the physical gold that sits in vaults around the world that can be delivered to the buyers who want physical gold delivered is running low relative to the amount of derivative commitments against the underlying physical gold. And so I think part of the run up obviously was hedge funds chasing momentum, piling into the long side on the Comex. And part of it was driven by the physical market. And India was largely absent from the physical market for the summer, and they're kicking in big time right now. But China was buying a lot of gold over the summer, not in the reported numbers, but people forget that there's 2 ports of entry for gold into China that don't have numbers reported. And Russia's probably been the largest official accumulator of gold for quite some time now. So for me, when I look at the open interest, to me it reflects the desperation that set in with the banks to try and control the price rise of gold and to try and I mean, because that's what the Comex is all about. It's about managing the price of gold using paper. And the open interest, I mean, it's the only commodity that trades on the CME where you get such a dislocation between the amount of open interest in the futures versus the amount of underlying physical commodity that is supposedly available to deliver. So for instance, right now on the Comex, the open interest in paper gold is 64 times the amount of registered gold. The registered gold is gold that sits in the vaults that has been designated and approved for delivery. And that's 64 times. And the open interest is 8.5 times the total interest. Total amount of gold that's supposedly sitting in Comex warehouses. There's many of us who question the veracity of the warehouse reports and whether or not that physical gold is really there. But let's just assume that it is. I mean, that ratio of futures open interest to underlying physical commodity is absurd. And in any other market on the CME, historically, the CFTC's cracked down when you've had that big a dispersion between the paper open interest and the underlying physical. But for some reason, they look the other way on gold and silver. Mm-hmm. So I think that the explosion in open interest just reflects the amount of force and effort that it's required right now to put a brake on the upward movement in the price of gold.
Excuse me, as you're talking about an underlying lowering of physical metal and an increase in paper gold derivatives contracts, we often hear people talking about like a failure to deliver or a force majeure or something that blows up the Comex, for lack of a better terminology here. But with the proliferation of even more paper and perhaps an even more dwindling of those actual gold stocks, when this eventuality finally happens, this is going to be something even more spectacular than the people have already speculated on. So that's just one thing that comes to mind. The other thing that comes to mind, I don't know if you noticed this, but just in the past couple of weeks, like apparently the Bundesbank said that they had increased their reserves, but then they like rescinded it. And GATA even sent them a letter and they said, no, we didn't increase our gold reserves. Did you look into that, or did you have any comments or thoughts on that?
Yeah, I mean, it wasn't a large amount of gold. I saw the news reports. I saw the refutations of the news reports. I didn't want to, for me, spending time tracking down something like that is brain damage. I mean, who knows what's really going on? I mean, it's intentionally the gold trading, and especially the movement in physical gold, is one of the most opaque markets in the world. And that's because it's real money. And the people who have interest in accumulating real money and protecting the disclosure of their positions want to keep the market as opaque as possible. I mean, who really knows what's going on at the banks aside from what they're disclosing as their paper positions on the Comex or in the OTC derivatives report that comes out every quarter? Who really knows?
Yeah, and I find that interesting because, we talk about gold and silver are private. So it makes sense that people would not want to disclose what exactly they're doing. I mean, obviously there's official reporting one way or another, but that does make total sense the way that you have explained it. Because I also think about it, what came to my mind is it's a confidence thing, right? That's a confidence, right? Perhaps like a hit to the confidence saying the Western, Germany, I mean, we got military bases over there, land still, we got all sorts of stuff. So that would be a big hit to dollar confidence, in my opinion.
Well, that's the whole purpose of the Comex gold contract. Is it most people aren't even aware of this, but it didn't exist until 1974, not coincidentally a couple years after the U.S. went off the gold standard. And GATA actually dug up letters that were, a couple decades later, finally released for public consumption for anyone who was interested in the subject matter, where there's letters that go back and forth between Henry Kissinger and some of his advisors talking about the need to control the price of gold and to divert institutional money from buying physical gold into a gold derivative. And that's why the Comex gold contract was developed and debuted. So it's the whole purpose of the Comex gold contract is to control the price of gold to prevent undermining confidence in the paper dollar, the fiat currency.
Mm-hmm. And, when you're talking about like controlling the price of gold, one of the things that's been bothering me lately, and not a lot of people have been talking about this yet, is just I'm seeing an increase in all of these paper derivatives that, in my opinion, could be used to help control the price of gold. For example, the Shanghai Gold Exchange is now offering either US dollar or renminbi-based, financially settled only gold futures contracts on the Comex. That to me says it's just like kicking the can a little longer in this paper game. Additionally, Barclays has this zero fee ETN. So it's not even an ETF, and it's not even supposedly backed by gold or silver like the GLD or SLV is, but they've got these two brand new ETNs called G-Bug and S-Bug. And to me, that also speaks of just ways to, pull the interest away from actual gold and silver and just keep piling in those paper derivatives. So just more on the paper and the controlling the price and just, an increase in what appears to be even more derivatives that are branching out from the Comex. Did you have any thoughts you wanted to add on there? Have you looked into these new ETF or ETN or Shanghai products?
I haven't spent a lot of time on it. The CME Shanghai, I guess it's called the two-way contracts. One's based on the Shanghai Gold Exchange Gold Fix, and one's based on the Comex 100-ounce contract, and they're priced off of those. They're both offshore from China, and they're cash settled. They're pure paper derivatives. I'm not really sure what the motive is behind the Chinese decision to engage in it, other than maybe just to kind of show that they're cooperating with opening up their market. Supposedly, this is supposed to open up the Shanghai Gold Exchange to traders outside of Shanghai. It doesn't really, if you read what the contracts do, it doesn't really do that. And the other thing is, if you look at in the average daily volume on the CME contract, the one that trades off the CME, it averages 500 contracts a day. So, I mean, yeah, maybe it was dangled out there by the CME and the Comex as another potential derivative tool that can be used to manipulate the market, but it's not going to accomplish that unless this thing builds up, 200 times the volume that it's trading right now. And I don't think it could grow into something significant, but it's kind of a flea on an elephant's ass right now, if you ask me. And
Yeah.
the Barclays, G-Bug and S-Bug, that's another thing where I don't know why it's based off of a Barclays 3-month rolling gold index, and the G-Bug and the S-Bug are, they're ETNs, or call them ETFs. They're basically retail traded securities that let investors speculate on the directional movement of that index. I don't even know why Barclays thought a 3-month index was an appropriate index to measure the price of gold, but it's on a rolling basis. And again, those two ETNs, the volume is insignificant. It's I don't think it's really worth spending a lot of time looking into them or trading them.
Mm-hmm. Very interesting.
I think right now, and we're seeing it, on the Comex with the explosion in the open interest. No one in the regulatory bodies of our government who are put there to enforce laws and regulations are going to stop the banks from increasing the supply of their paper. And it's just as easy to print a paper. It's easier to print a paper gold contract than it is to print a Federal Reserve note.
Yeah.
And ultimately, with regard to the manipulation of the markets, it's just something that I've learned over the last, I've been doing this for almost 2 decades now, and I used to pull my hair out over it. You just got to live with it because it's a fact of life, and no one in an official position is going to try and stop it. Eventually, what'll happen is they're going to run out of physical gold to satisfy the delivery requirements, and it won't be a U.S. based investor because they've been told to stay away, and I'm sure they're pointed to the example that was made of the Hunt brothers back in 1980. It'll be someone, either China, India, Russia, whatever, even Turkey. Turkey bought a lot of gold last month, the central bank. Someone's going to ask for a large delivery, and it will go unfulfilled. The counterparty who's short the derivative won't be able to make delivery, and that's what's going to blow up the market. And there's precedence for that. We saw it in the 1960s with the London gold pool. And that's ultimately led to the reason why Nixon had to close the gold window. So this is just one of those things that you got to let play out. I would look at it positively that gold made the move that it made this summer. And from a technical standpoint, I think it's positive that it's actually pulling back. I hate it when gold and silver go parabolic because it means they're going to reverse. And in this case, they're pulling back, whether it's manipulated or not. Technically, it's going to be healthy. So, and to me, the massive run up in the Comex open interest is reflects or signals that they're starting to lose a little bit of control, or maybe a lot of control over their ability to manage the physical price of gold, or the ability of the physical gold market to set the price of gold. I mean, I looked at some numbers last week, and the last time gold was around the 1500 level and falling was 2013. The open interest on the Comex was a little over 400,000 contracts. So it's taken nearly twice as many contracts to keep this 1500 level capped.
And it's interesting because silver has not yet hit a new all-time high in open interest. Maybe you want to speak to that, but I want to talk about silver for a second, transition into that. It's interesting to me because we can, there's 4 precious metals, right? We can, not talk about the exotics for now. Let's just talk about the 4. two. But let's talk about, oftentimes I like to do this, and I just did the math again this morning because it proves a point. If you average the price of gold, platinum, and palladium, you come up with $1,325 an ounce. If you throw silver in there today, the average price for 1 ounce of a precious metal, if you average gold, platinum, palladium, and silver, is $1,000 an ounce. And here on November 12th, we have silver sitting under $16.75. So I guess, what is your outlook for silver? What are your thoughts on silver in general? What do you think about the current gold to silver ratio? And there's a few different questions or angles there. So just take that how you want to, Dave.
Sure. There's 2 precious metals. For me, palladium and platinum they really have more of an industrial function. I mean, you could say they're precious in terms of their scarcity value, but they'll never be used as monetary metals. So that's why I focus on gold and silver. It's honest money, it's real money, and it's they're really the 2 monetary metals. I mean, even copper's really more of an industrial metal. But silver is the conundrum, and over very long periods of time, the gold-silver ratio trends towards 16 or lower, and that dates back to Roman times when it was set at 8-1, and that was pretty much the ratio of the number of ounces of silver being pulled out of the ground per ounce of gold. And believe it or not, if you fast forward to today, that's roughly what it is now. It's about 9 ounces or 10 ounces of silver is pulled out of the ground for every ounce of gold. So the gold-silver ratio is I mean, it's about as high as it's ever been in a historical context. And at some point, it's going to come down a lot. And I think the fact that it's been pushed up to where it is now, part of it has to do with what happened between 2011 and 2016, the beginning of 2016, that massive manipulated correction in the market. I think that scared away a lot of retail investors who were helping to drive the price of silver at the margin. And at some point, we'll see them come back, because people are going to wake up one day and the stock market will be down. The Dow will be down 1,000, and banks may or may not start closing temporarily, and people are going to be like, "Whoa, what's going on? Maybe I better get some silver." And so that's the type of dynamic that I think could ultimately really drive the gold and silver market. But right now, I think a big part of the trading that goes on between gold and silver is hedge funds, doing arb trades, with the gold silver ratio between going long long or short gold contracts versus silver contracts. And so even to that extent, I mean, to the extent that gold and silver are manipulated, the gold silver ratio is manipulated. And it's been slowly kind of trending lower. And I think, you know, again, I hate to forecast the future in this area because it's unpredictable because of the manipulation. But I think we're going to start to see the gold silver ratio go a lot lower. And obviously that means that the price of silver is going to start catching up with gold. So, I mean, if you like gold, you may as well buy silver because it's leveraged to the price of gold until that ratio gets, you know, more normalized.
Switching to the actual stock market here, you know, a lot of professional big names have lost their shirts trying to short this market, you know, and then you got the Elliott waivers out there doing their thing. You got, you know, technical analysts talking about, you know, oh, we got a textbook Fibonacci retracement and we're bouncing off of this exponential moving average. And I mean, Dave, how do you get a sense of these markets and an understanding of where you think these markets might be headed? Is it purely fundamental? Is it purely technical? What are some of the things that you do to get a feeling for these markets?
I don't know. With regard to the Elliott waivers, I always, when I hear that, I always think about a big football stadium, say Ohio State, you know, full of people doing the wave. You can't make sense of these markets right now because there's been such an extreme amount of central bank intervention, and they re-upped the ante, you know, when the Fed started the not QE repo programs, which will morph into massive QE. I mean, you've got negative interest rate yielding bonds. I mean, that's insane. The central banks and all the money printing has completely removed any semblance of price discovery from these markets. And that's across all the asset classes, fixed income, equities, commodities, you know, especially gold and silver. There's just no price discovery. So you can't make sense of it. Now, in terms of you know, the market itself and whether or not you can make money shorting it, there's a lot of stocks that are below their 200-day moving average. I looked at the numbers a couple of weeks ago for my short sellers journal, and it's less than 5 or 6 stocks that are driving the Dow higher, and it'd be the same 5 or 6 stocks that are driving the S&P higher. So yeah, the marquee indices are hitting records and starting to go parabolic. But beneath the surface, there's a lot of stocks that are getting hammered. One example is Wayfair, which I've been recommending, pounding the table as a short in my short sellers journal. And that stock's been cut in half since like June. Credit Acceptance Corp took about $100 plunge from its recent high last week. You know, so, and that's another one that I've looked at. Another one is, believe it or not, FICO. I put a strong short recommendation on it when it was up at 340 earlier this summer, maybe I think it was July, and that stock went below 300 briefly. Roku, when it was just before it hit its high at 170, I threw it in my short sellers journal. I said, look, you know, I can't tell you the timing of when this thing's going to go down, but it's going a lot lower. And I recommended February 50 strike calls. And just, I mean, I got lucky to an extent, but 2.5 weeks later, the stock was down 70 points. And those puts that I recommended were like triple, you know, a 3-bagger. So there's plenty of opportunities to short stocks out here because there's so many of them that are just, you know, they don't have sustainable business models. They've been kept alive by the Fed's money printing and all the cash sloshing around. You know, Netflix is a good example. If they couldn't finance in the junk bond market, they'd have to restructure their entire balance sheet and the stock would be largely worthless. So you just got to spend time digging around. And, you know, that's why I put out the short sellers journal. And I don't get discouraged by this. In fact, what I see is every day the stock market goes up, it creates more opportunities to make money on the short side.
Yeah, and I think this is fascinating because if I'm understanding it this right, it's almost like you could think of like the charts as like the front end, like right, like the part of the restaurant where people go in and eat, right? Whereas like where what I'm getting an understanding is that you're looking into the companies themselves, and that's kind of like going around and poking in the kitchen and just seeing how dirty it is
It's
in
a
that
good
kitchen.
analogy. I like it.
So if I'm understanding this right, because like the other thing is, it also sounds like you don't want to go near these dandies and these unicorns because people get their faces ripped off trying to short those things. So I think just being able to understand where those companies are in relation to their valuations is the key here. Is that in a good understanding, Dave? Now, Dave, one of the things that I'm curious about is a Twitter effect because some people think that, President Trump's tweets don't have an effect on the markets, but I think that President Trump's tweets clearly have an effect on the market. And, he talks a lot about the dollar. He talks a lot about the stock market. He talks a lot about interest rates. What do you think about when you're looking at like President Trump's Twitter and how Twitter can interact with the markets here? Do you think that that is something that investors and traders have to take into consideration?
Oh, absolutely. I mean, the hedge funds, the computer software is so sophisticated. I mean, they've got whatever you call them, crawlers that scan everything that's posted on Twitter. And anything, something on Twitter that the algos pick up on that gives them a reason to pile into S&P futures or sell S&P futures. I mean, Twitter can trigger it, and Trump's the perfect example. I mean, anyone who doesn't think that Trump's tweets influence the stock market is either tragically naive or just completely ignorant. So and there's no question Trump, it's on purpose. I mean, it's all part of this kind of propaganda, fake news, and Trump's figured out that he can move the stock market like a yo-yo with his trade war tweets. And the funniest thing was, I think it was last week, Trump tweets market at an all-time high, spend your money well. I mean,
Yes.
he was talking to the top 1% of the wealth demographic. I mean, most of the stock, and I can't remember the numbers off the top of my head. It's something like 95% of all the stock is owned by the top 10% wealth demographic, and 50% of that's held by the top 1%. Mm-hmm. Below the 90, below the top 10%, these people, to the extent that they might have a small exposure in stocks, it's through their 401ks, their IRAs, and many of them have already cashed them out to make ends meet. Mm-hmm. So when I saw that, I almost fell off my chair laughing. Spend it well. Great. So you really think you're making the whole country richer by pushing up the stock market with your BS?
That one, and then on top of that, he's openly called for negative interest rates on Twitter too. And I'm thinking, my goodness, just talk about sticking it to the savers here. And like nobody calls him out on this because it's so divisive in this country with Trump right now. You're either with him or you're against him, and there's absolutely no middle. And I would just consider myself just like, unfortunately, I have to talk about it because President Trump is talking about the markets, and that's what I do is I talk about the markets and the economy. So it's unavoidable, but there's just so much hostility around the whole Trump thing that it's just cutthroat as far as if you're supporting him, if you're not supporting him. But there's no denying that's got an effect on the markets there.
Well, to be honest, I'm a political atheist. I can't stand politicians. I don't identify with either party. I despise Trump as much as I despised Obama, as much as I despised W, as much as I despised Clinton, etc. And to me, Trump has made it clear that he sees his reelection. He sees his chances of reelection are improved greatly if he can keep the stock market rising higher. And that's his whole MO right now. I don't even know if he really cares that much about, anything else. other than manipulating the trade war headlines.
That's one thing I wanted to ask you because, last week, everybody was looking for this crash in October. And last week, I mean, where did all of this newfound optimism came? I mean, everybody was so optimistic all week long about the trade war. There's progress. There's progress. President Trump, I think, tweeted more than once a day about record high stock markets. So just as far as the trade war in general, is there an end to this? Is there going to be a deal coming? Talk to us a little bit more about the trade war and what you think about when you see and hear news about the trade war, Dave.
I mean, it's hard to know what's really going on behind the scenes, but I think that the main issues, the IP protections and anything technology related and the sharing or the theft of technology, I think those issues are going to get in the way of a trade war settlement. I mean, to me, people want to. I think the trade war partially was created as sort of a propaganda prop, sort of in the Orwellian sense, so that everyone can have a boogeyman to point to for blaming the coming. We're getting ready to go into a major economic recession / depression globally, including the U.S. I mean, again, most of at least half of the population wealth demographic in this country is already in a deep recession. 44% of the households have expenses that exceed income. I think the trade war was hung out there as a scapegoat, but we were going to go into a deep recession regardless of whether there was a trade war or not, because there's just too much debt, and the world sucked up so much debt over the last 10 years that that debt we're at the point where you can't service it. Mm-hmm. And so the only thing you can do at a certain level to try and keep it going is print money. And whether or not there's a trade war, that's not why economic activity is contracting. It may have hastened it or exacerbated it, but it's not the cause. And so the trade war is a political prop right now, and Trump's figured out a way to use the sound bites to manipulate the stock market. And I mean, there is a correlation, a very strong correlation between the directional movement in the S&P and sentiment, household or consumer sentiment. So when people see the stock market going higher, they don't necessarily understand why it's going higher, but it gives them hope. And so some of the confidence polls are showing confidence is starting to plummet again. And then there's some of them, depending on how they're constructed, that show confidence is near, recent highs. So, and to the extent that they're near recent highs, it's just because the stock market's been going higher. And again, remember, it's not the stock market that's going higher. It's a handful of stocks in the main indices that are going higher.
Now, Dave, we'd like to catch up with you at the beginning of next year, 2020. So until that time, as we come in through these last couple of months here, what is going to be on your radar the most as we wind down 2019, Dave?
I don't know, but I'm busy New Year's Day, so it'll have to be after New Year's Day.
Sounds good. Because I see, chaos. I see chaos everywhere, right? I see protests and violent clashes in Chile and Venezuela. I see problems that are over in Hong Kong. I see problems in the Middle East. I see problems in where was it? I think it was in Lebanon, or was it Libya most recently? But anyway, my point is there seems to be a lot of angst and a lot of just problems that are starting to move down to street level, starting to move down to Main Street. And I think it's going to be kind of hard to mask these fundamental problems in the economy and in society in general. Any thoughts on that for closing thoughts there, Dave?
Well, certainly. I mean, going into the end of the year, for me, the only issue is whether or not the stock market's going to catch down to reality, or if the Fed's going to be able to keep it moving higher by printing more money. At some point, you're going to get diminishing returns from the money that they're printing and throwing into the financial system, and they're going to have to increase that. And at some point, it's going to undermine the dollar. And so, I mean, again, I can't predict when it's going to happen. It's impossible because there's just no price discovery anymore in these markets. But at some point, the stock market, you're going to wake up one day and it's the futures are going to be limit down. And I think at some point, and I don't know if it'll happen before the end of the year or before the end of next year, or by June. At some point, I think we're going to see that they'll have to just turn off the stock market to stop the selling. At some point, the plunge protection team is not going to be able to contain the selling that kicks in from the algos, the hedge fund algos, and so they're just going to pull the plug temporarily. And again, I doubt we'll see that by the end of the year, but we're going to see that eventually. And I think going into the end of the year, I think you're just going to see a continued dislocation between financial paper assets and underlying economic reality. I'm most interested to see how the retail sales come in. Now, you got to remember that is a very highly massaged number, and half of it, when they do an advance estimate on retail sales, half of it is based on guesstimates. They don't even have the real data. But I think it's going to be hard for them to mask what I think is going to be a very disappointing holiday season. Again, here's another case where Thanksgiving's late this year, so they're going to blame it on a shortened holiday season, which is total nonsense. I mean, Black Friday now is every Friday starting in mid-October.
Yeah.
I mean, I was getting Black Friday ads in my email 2 weeks ago or pre-Black Friday.
Yeah.
So I think Amazon foreshadowed what we're going to see this retail season when they guided their fourth quarter a lot lower.
Dave Kranzler, I'd like to thank you for joining us again on Silver Doctors.
Thanks for having me, Paul. I had a great time.
I can't see you at all, Dave. I guess there was no video in this second part, but that's okay.
Shoot, I forgot to turn it on. I'm sorry. We had my internet interruption. I forgot to turn the video back on.
No problem. They can look at my pretty face on the screen. But anyway, that'll be interesting, that retail sales report. You usually do really cool little articles about those kind of things, because you like you go into all these reports and you're like, oh, check out this footnote. You see that? They just did that right there. So you like expose it.
The algos respond to the headlines, and the propagandists know that.
Mm-hmm.
So that's one way that they manipulate the stock market, is they put these headlines out, and the algos don't go into the guts of the report, and neither do the portfolio managers. They just look at the headlines, see everything's great.
Yes, and what didn't get coverage? GDP, right? That was like a fleeting headline because it was 1.9%. Nobody talked about GDP. It was it was reported on, and it was gone as fast as it was reported on.
Exactly.
So.